We've got Ryan Payne, Payne Capital Management President and host of the Payne Points of Wealth podcast. Congratulations on the podcast, Ryan. I know you're dying to get in and weigh in on Bitcoin, but I have to ask you, given the volatility that we've seen over the last week, I mean, certainly volatility in the crypto space is nothing new, but I wonder if there is any correlation that you see here between that and some of the jitters in the equity space.
I don't know if they're highly correlated. I think the bigger correlation right now is the biggest competition, and you're actually seeing this with a lot of these disruptive technologies, right? The Zooms of the world, the Pelotons, anything where we are working inside. But it's like the real disruptor right now is real life, because I think people are actually starting to leave their homes, leave their apartments again. Obviously, the CDC came out with that big announcement that if you've been vaccinated, you can now go out without a mask, whether you're outside or indoors. And I suspect, Akiko, that a lot of the speculation that we're seeing in these cryptocurrencies was people locked inside with these stimulus checks, and you couldn't go to Atlantic City, you couldn't go to Las Vegas. But now all those dynamics are changing. So I think a lot of it has to do with the fact that reality, or living in the real world again, is your biggest competition with a lot of these quote unquote disruptive technologies. And I talk a lot about this on my podcast.
I mean, having said that, though, Ryan, you've got Goldman Sachs coming out with a note saying that Bitcoin is an investable asset. You've got somebody like Ray Dalio saying he's dabbling in it just a bit. I mean, isn't there still a case on the institutional side, despite what we have heard about institutional money sort of moving out of cryptos?
Well, I could make the same argument back in 08, 09 with the housing crisis. Big companies like Merrill Lynch, Lehman Brothers thought it was a great idea to leverage up mortgages on their balance sheet. And that didn't end well either. So just because big institutions are getting involved, I wouldn't necessarily say that's a good thing. In fact, a lot of times when big institutions embrace a lot of these concepts, they're usually late to the party, especially in the financial world. So I would be really careful about that, because at the end of the day, if you break it down fundamentally, it's still a horrible store value of money. I run a business. I couldn't imagine if I was looking at my cash position every day and I had it in Bitcoin, and all of a sudden it's down 50% and I've got my bills to pay. One of the reasons why Tesla, I suspect, stopped taking payment in crypto for their Teslas. So, at the end of the day, it's still 75% of all transactions are for illicit transactions. And I have to think, central banks, they love to control the money supply. Call me crazy, but I just don't think they're going to give that up, Akiko. I know that sounds crazy, but at this point, I just don't think that's going to happen.
When you look at the fundamentals in the market, is inflation still the key risk? And if that's the case, what's the hedge for you?
Well, I think, look, the markets tend to, history doesn't repeat, but it does rhyme, as Mark Twain once said. And there's no secret. Inflation is real, right? It's not, quote unquote, transitory like the Fed's telling you right now. I mean, you just have to walk outside. You see what prices look like when it comes to lumber, when it comes to copper, it comes to even going to the grocery store at this point, or ordering on Seamless. As we know, they just mark it up exponentially. Inflation is here, and the bigger part of inflation, the bigger factor is those labor costs going up. You're seeing, McDonald's, whether it's a lot of these food restaurants, they're offering you a bonus just to come to the interview right now. So inflationary pressure is 100% real. But if you look at it traditionally, what works well when you have inflation? Well, commodities do really, really well. And, commodities have intrinsic value. Like, you actually need commodities in society. Whereas crypto, I can't build a house with crypto, but I can definitely build it with lumber. Material stocks, any company that can raise their prices on you when the raw material costs go up. And we're already seeing that, right? That's why value stocks are dramatically outperforming this year. If you're Coca-Cola, you can raise your prices on the consumer if you're Procter & Gamble. And they're already starting to happen. You're already starting to watch these earnings calls. They're saying our raw material costs are going up. And guess what? We're not that benevolent. We're going to raise prices on you. So, stocks invariably, cyclical stocks are invariably a tremendous inflation hedge. They've been historically, and we know commodities are as well, and even commodity-based economies. So if you think of emerging markets, whether you're Brazil or some of these other economies where they are based in commodities, they're going to benefit as well. So you have to have these kind of assets in your portfolio. Crypto has no history of being an inflation hedge. It doesn't exist. So this, belief that it's like the new gold, which, by the way, gold's a horrible long-term investment. If you look at a 100-year history of gold, it's actually done like 1% a year over inflation. It's a terrible hedge. So another horrible argument for why you shouldn't own crypto. So I think, history already tells you what's going to work. And you've got to embrace that. Like all our portfolios, and again, we do talk about this like week after week on our podcast, are diversified in all those inflation hedges, and they're working. Big tech is going sideways. Meanwhile, value stocks are going up, commodities going up. The market's already telling you that's what's happening.
Got to get those podcast plugs in, Ryan. I appreciate that. We know you've always been a value trader. But I wonder what the breakdown is for you right now when you look at your portfolio. How much exposure to growth, and if so, what are some names that you think have real upside even in this environment?
You always have growth in your portfolio. So I'll put that caveat out there. We always have an exposure to growth in our portfolio. I still have big cap tech in there. But the bottom line is it's only a component of our portfolios. So, for our portfolios right now, we have an absolute healthy allocation to value stocks. And again, just like I mentioned before, owning companies like Procter & Gamble, old school companies, owning companies like Johnson & Johnson, old school pharmaceuticals, anything that's like a Pepsi, a Coke, right? Anywhere where you can have price increases is great. Furthermore, and I think we're actually rare in this, is 40% of our portfolios are overseas. Because you got to remember, foreign markets do just as well as the U.S. market over time, and those companies tend to be more cyclical. Cyclical companies, again, benefit when you're in an inflationary environment. Furthermore, it comes down to value. If you look at foreign companies right now, they trade at much lower multiples than U.S. companies, and it's crazy, but next year, GDP growth in Europe is going to be faster than the U.S. Now, I can get cheaper companies that pay, and the dividend increases are going to be higher this year as well, that are going to grow faster over the next couple of years. I call that an offer you can't refuse. So the dollar's weakening. It's probably going to continue to weaken as money goes around the globe, and you've got to have that position in your portfolio as well. Like this is the next decade of global investing, cyclical value stocks. Last decade was deflationary environment, large cap growth, tech. That party is over.
All right, you heard it here, and you can also hear it on the podcast. Points of Wealth. Ryan Payne, Payne Capital Management President. Good to talk to you today.